So here's the big question. Can Webull's undeniable growth and, frankly, pretty innovative platform outrun the long shadow of its Chinese origins? And, the intense scrutiny from US lawmakers. Is this a fintech bull ready to really charge? Or is it maybe facing a geopolitical bear trap? We're about to unpack all of that. We're doing a detailed analysis of Webull Corporation, trading on NASDAQ, ticker BULL. It closed at $13.22 on July 2nd, 2025. Welcome to the deep dive. This is where we take your sources, could be articles, research papers, even your own notes, and we just pull out the most important bits of knowledge and insight. Think of it as your shortcut to being genuinely well-informed, hopefully with a few surprising facts, maybe a little humor to keep things interesting. Today, we're diving deep into Webull Corporation. We're using a detailed research analysis as our roadmap, our goal, to guide you through its business, its management, the financials, market position, and those significant risks it faces, helping you understand what really matters here. We've split this into two main parts.
First up, chapters 1 through 3. That's the business analysis, management evaluation, and a good look at the financials. Then, in part 2, we'll tackle market sentiment, the ownership structure, a critical risk assessment, and wrap it up with our conclusion, chapters 4 through 7. Okay, let's jump right in. So to really get Webull, we need to understand its core business. Let's start with chapter 1. Business analysis. What's their angle? And, how do they make money if trading is supposed to be free?
Right. Well, what's really interesting is their freemium model. They pull people in with commission-free trading for stocks, ETFs, options. It removes that initial cost hurdle, right? Creates this huge funnel of potential customers.
Okay, but the money. If trading's free, how do they actually profit?
Good question. It's through several pretty sophisticated back-end revenue streams. Common stuff in the brokerage world, actually. A really big piece is payment for order flow, or PFOF.
PFOF, right.
Yeah. So instead of sending your order straight to an exchange, Webull routes it to high-frequency trading firms, market makers, who pay them a small fee for that order flow.
Okay. That gets criticized sometimes, doesn't it? Potential conflict of interest.
It does, yeah. But U.S. regulations mandate best execution for clients. Webull has to show they're getting the best possible price for you despite receiving PFOF. And their Q1 2025 results really confirm that trading-related revenue, which is heavily PFOF, it's a cornerstone of their income.
Okay, so PFOF is big. What else?
There's margin lending charging interest when users borrow money to trade. Pretty standard. Interest on uninvested cash. Like a bank, they earn a spread on the cash just sitting in accounts. Though premium users get a competitive 4.1 EBIR pro APY, which is decent. Then there's the stock loan program. They lend out customer securities, typically for short selling, and share some of the interest earned with the customer. And more recently, in March 2025, they launched Webull Premium. That's for enhanced features, better rates, aiming for that stable, recurring subscription revenue. Plus, users can pay extra for level 2 market data.
Wow. Okay. So quite a few different streams feeding into the revenue pot. What about the actual products and services they offer? Is it just for day traders?
No, not entirely. They've built out a pretty comprehensive ecosystem. You can access it on mobile, web, desktop. The core trading platform is definitely the heart of it. It offers U.S.-listed stocks, over 300 ETFs, multi-leg options, futures. It is geared towards active and intermediate traders. Advanced charting, free real-time data, paper trading, those extended trading hours.
4 a.m. to 8 p.m. ET, right? That's
Yeah.
pretty wide.
Exactly, but they've made some strategic moves beyond that. They shifted crypto trading to a separate app, Webull Pay, back in June 2023. That was likely to de-risk from the volatile digital asset regulations. They also have Webull Advisors, their robo-advisory service. And just this past May, they seriously enhanced it by partnering with BlackRock. So now they offer professionally managed portfolios.
Partnering with BlackRock, that's a significant step.
It is. And they've also moved into past management and fixed income, offering high APY on cash, money market funds, and now U.S. Treasury bonds. Crucially, they offer fractional bond investing, which lowers the barrier for smaller investors.
So they're really broadening their appeal beyond just this super active trader. How big are they now? What's their scale compared to others?
They've got a rapidly growing global footprint, operating in 14 markets worldwide, licensed broker-dealers in 12 of those. As of the first quarter of 2025, they reported 24.1 million registered users globally. That's up 17% year over year. And 4.7 million funded accounts, holding about $12.6 billion in customer assets. That asset figure jumped 45% year over year. So really strong growth.
How does that compare to, say, the big name, Robinhood?
Right, well, Robinhood is definitely larger, especially in the U.S. market. End of 2024, Robinhood had something like 25.2 million funded customers and way more assets, around $193 billion. But here's an interesting point. Webull's average account size is quite a bit smaller, roughly $2,900 compared to Robinhood's average of over $7,600.
What does that suggest?
Well, it could suggest a few things. Maybe Webull's user base is generally less affluent, or perhaps they're using Webull for smaller, more speculative portfolios rather than their main long-term investments. It kind of points to maybe a different type of user, or at least a different use case.
Okay, that makes sense. So what's their core appeal then? Their main value proposition?
They really target what they call sophisticated retail customers, offering a powerful, feature-rich platform but at a low cost, essentially free commissions. Their unofficial motto captures it: zero commission, zero compromise. They're trying to bridge that gap, more advanced than a basic app like Robinhood, but maybe not as complex or costly as an institutional platform like Interactive Brokers. And crucially, it's accessible across multiple platforms.
Let's talk about the wider industry. What are the big trends driving this online trading market?
Yeah, the whole online trading platform market is expanding fast. Projections show it growing from around $7.1 billion in 2024 to nearly $9.8 billion by 2030. Some reports even suggest faster growth for e-brokerage specifically, maybe 9.4% CAGR through 2034.
And what's fueling that?
A few key trends. First, the democratization of finance. More everyday people getting into investing, especially Gen Z and millennials who are drawn to low fees and mobile-first designs. Second, just the overall digitalization and mobile-first expectation. People want to manage everything on their phones. Third, technological innovation. Think AI and machine learning being used for trading insights and platform features. And finally, the expansion of asset classes. It's not just stocks anymore. People want crypto, maybe prediction markets, access to everything on one platform. Webull seems pretty well positioned for most of these trends.
So given those trends, what's the competitive landscape look like? Who are they really up against?
Oh, it's intensely competitive. You've got direct fintech rivals, with Robinhood being the closest comp, though as we said, Webull targets slightly more intermediate active traders with more tools. Then you have the incumbent behemoths, Charles Schwab, Fidelity. They manage trillions, offer comprehensive long-term wealth building, mutual funds, bonds, even in-person advice. That's a whole different ballgame and an area where Webull is, frankly, weaker. And finally, you have the professional-grade platforms like Interactive Brokers, IBKR. That's the gold standard for really sophisticated global traders needing advanced order types, APIs, stuff like that. Webull doesn't really compete at that institutional level. So Webull sits in this kind of strategic but definitely challenging middle ground.
Right. And what about the rules? What's the regulatory environment like for a company like Webull? Sounds like it could be pretty complex.
It is very complex. The U.S. online brokerage industry is heavily regulated by the SEC and FINRA. Webull Financial LLC, their U.S. arm, has to comply with a ton of strict rules. Things like know your customer, KYC, and anti-money laundering, AML requirements.
Standard stuff for finance.
Exactly. Then there are the best execution rules for orders, which ties back to that PFOF discussion. Margin requirements, capital requirements to ensure they're financially sound, and the environment is always changing, especially around digital assets, which, as we saw, influence the Webull pay split. And, crucially for Webull, data privacy. Laws like the Protecting Americans' Data from Foreign Adversaries Act are highly relevant given Webull's international ownership structure and Chinese origins.
That sounds like a significant hurdle. What about barriers to entry generally? Is it easy for new players to jump into this market?
Not easy at all. I mean, fintech has lowered some barriers, sure, but formidable obstacles remain. First, those regulatory and licensing hurdles. Getting approved by the SEC and FINRA is a long, complex, and expensive process. You need serious legal and compliance resources. Second, the technology and infrastructure investment. Building a secure, reliable, scalable platform that can handle millions of users and transactions costs hundreds of millions of dollars. It's a huge upfront cost. Third, brand trust and customer acquisition. Finance is built on trust. Building that reputation takes years and massive marketing budgets. Getting people to switch brokers isn't easy. And finally, economies of scale and network effects. Larger brokers can spread their high fixed costs over more users, allowing them to offer lower prices. Plus, features like Webull's community create a network effect. The more people use it, the more valuable it becomes, increasing user stickiness.
Okay, so despite the challenges, Webull has clearly carved out a space. What are their key competitive advantages then? What really makes them stand out?
They definitely have several distinct advantages. First, their brand strength and recognition is impressive for a relatively young company. They're often mentioned in the same breath as Robinhood, and they've picked up industry awards like Best Brokerage App. Their global expansion helps solidify this too. Second, cost advantages or economies of scale. That zero commission model is aggressive. It's enabled by a lean, tech-focused operation. As their user base grew to over 24 million, those fixed tech costs get spread thinner. We saw that in Q1 2025, revenue up 32%, but operating expenses actually decreased by 2%. That's powerful operating leverage.
Yeah, that leverage is key. What else?
Third, network effects or switching costs. Their in-app community fosters engagement, keeps users on the platform, and while the actual fee to transfer assets out, $75, is relatively low, the non-financial switching cost is higher. Users invest time learning their customizable, advanced platform. Mastering it creates a kind of lock-in. And finally, I'd say their unique assets or capabilities, specifically their proprietary technology platform. It manages to balance a rich feature set with a pretty user-friendly interface, which is a tough needle to thread. This tech prowess also allows them to roll out features and expand globally across different regulatory environments relatively quickly.
This is a really thorough look at the business side. Let's shift gears now and talk about the people running the show. Let's move to Chapter 2, Management Evaluation. What's the story with their leadership?
Right. When we look at management, we want to see their track record. Webull's leadership is an interesting mix Wall Street experience combined with tech entrepreneurship. You've got Anthony Denier. He's the group president and U.S. CEO, really the public face in the West. He's got over 2 decades in traditional finance, was involved in pioneering electronic trading at Credit Suisse, then ING, later CEO of LXM Financial. He got promoted to group president in January 2024, tasked with driving global expansion and ensuring compliance. His FINRA broker check record is extensive, as you'd expect. Then there's Anquan Wang. He's the founder and CEO of the parent company. His background is much more in tech. He was previously at Xiaomi, and he founded Hunan Fumi Information Technology, which was kind of the precursor to Webull. He's the one driving that tech-first culture.
How did they navigate that whole GameStop short squeeze chaos back in 2021? That was a real stress test for brokers.
It really was, and Webull's handling was actually quite different from, say, Robinhood's, which faced a lot of criticism for opaque communication. Webull, under Denier's leadership in the U.S., was pretty quick and transparent in explaining why they had to impose trading restrictions. They clearly stated it was due to directives from their clearing firm, Apex Clearing, because collateral requirements were skyrocketing.
The clearinghouse requirements.
Exactly. That transparency might have actually helped solidify Webull's brand among slightly more experienced retail investors who understood the plumbing of the market compared to maybe users who just saw it as being blocked from trading.
Okay, so transparency in that crisis.
Mm-hmm.
What about their overall transparency and ethical reputation now, especially with those China-related questions hanging around?
Yeah, this is where it gets complicated, and it really speaks to that core tension we started with. Officially, their communications are professional, all about growth, innovation, new products. However, they face serious, persistent questions because of their Chinese origins and ownership structure. That letter from the U.S. House Select Committee on the CCP in late 2024 is a prime example. It accused them of obscuring ties to China-based tech firms, raising significant data security and compliance concerns.
What's Webull's response to that?
Webull consistently states that U.S. customer data is stored strictly within the U.S. and is inaccessible from outside the country. But that political scrutiny hasn't gone away. And then there's this gap you sometimes see between the slick corporate image and user experience. Looking at the Better Business Bureau, there were 121 complaints in 3 years, things like withdrawal issues, account restrictions, unresponsive customer service. That stuff matters for reputation, too.
So definitely mixed signals there on the reputation front. How are they using their money? What's their approach to capital allocation?
Well, they're a high-growth company that just went public via SPAC merger in April 2025. So, unsurprisingly, their capital allocation is laser-focused on reinvesting for future growth. The priorities are clear: broadening the product portfolio, like the BlackRock partnership for Webull Advisors, adding prediction markets with Kalshi, and pursuing aggressive global expansion.
Right. Entering new markets costs money.
Exactly. Licensing, setting up operations. It requires significant capital.
Yeah.
And even the SPAC merger itself was a strategic capital allocation decision, a way to gain that NASDAQ listing and raise capital specifically for growth initiatives.
Are they giving anything back to shareholders yet? Dividends? Buybacks?
No, nothing like that. They don't pay a dividend, and there's no history of share buyback programs. All the capital is being plowed back into the business. So if you're investing in Webull, you're banking purely on capital appreciation from growth, not income.
That focus on reinvestment leads to a key question. How efficiently are they actually using that capital? What can we say about their return on invested capital, or ROIC?
Yeah, calculating a precise long-term ROIC is tricky because their public history is so short. We know they were unprofitable in 2024, so the ROIC then would have been negative. But Q1 2025, as we keep saying, looks like a potential turning point. They reported $12.9 million in net income, $28.7 million in adjusted operating profit. That strongly suggests those investments are starting to generate returns. The key question now is sustainability. Was Q1 a blip driven by market conditions, or is this the start of consistent profitability and positive ROIC? That's what investors need to watch.
All right, let's dive into those numbers more deeply. Time for Chapter 3, financial analysis. What are the key metrics we should focus on?
Okay, let's start with the basics. Market cap. As of July 2nd, 2025, Webull's market capitalization is hovering around $10.8 billion. That puts it firmly in the mid-cap growth stock category, much smaller than, say, Schwab at $165 billion, but getting closer to Robinhood's $73 billion, is still significantly smaller. It definitely signals that the market expects substantial growth.
In revenue growth, what's the trend there?
A full 5-year history isn't public yet because they only recently listed. We know that for the full fiscal year 2024, revenue was around $390 million, which is actually pretty flat compared to the year before. But UTQ1 2025 showed a dramatic reacceleration. Total revenue hit $117.4 million. That's a remarkable 32% increase year over year.
Wow, 32% jump in Q1. What drove that?
Mostly driven by a huge 52% increase in trading-related revenue. So market activity was likely strong, and they captured more of it. This recent surge is absolutely critical for the investment story.
Okay, revenue reaccelerated. What about profit margins? You mentioned they turned profitable in Q1.
Exactly. In 2024, they were unprofitable net loss of about $22.7 million. Even Q1 of 2024 saw a loss of $12.6 million. Then Q1 2025 hits. $12.9 million in net income. The swing is huge. Their adjusted operating margin improved by an astounding 22 percentage points, hitting 24.4%.
And that ties back to the operating leverage you mentioned.
Precisely. Revenues grew 32%, but total operating expenses actually decreased by 2.0%. That shows incredible operating leverage. Each extra dollar of revenue is dropping to the bottom line at a very high rate. Very efficient growth in that quarter.
What about cash flow? Are they generating free cash flow yet?
Again, a full history isn't available, but for the 9 months ending September 30, 2024, they actually had a net cash outflow from operations of about $121 million. So they were burning cash, likely funding that expansion. Investors really need to watch closely now to see if that newfound profitability starts translating into positive and hopefully growing free cash flow. That's a key sign of financial health.
So Q1 2025 really does seem pivotal. How stable do these financials look going forward? Can we rely on these numbers?
Well, earnings consistency isn't established yet. That Q1 profit is a fantastic sign, a potential inflection point, but we need more data points. Was it a one-off boost from market volatility or the start of a sustainable trend? Too early to say for sure. What about their debt-to-equity ratio? Their U.S. subsidiary had a high ratio back in 2022. But a lot of that was apparently customer payables, not traditional corporate debt. A preliminary report after the SPAC merger in April 2024 suggested a low debt-to-equity ratio for the consolidated parent company, which implies a pretty strong overall financial position.
And short-term liquidity.
Seems okay. That same April 2024 report showed a working capital surplus of $9.4 million, suggesting they have enough current assets to cover short-term liabilities. So healthy short-term liquidity.
Okay, now let's get to valuation. This is always tricky, especially for a newly public growth company. How is Webull priced compared to its peers? And what might its intrinsic value actually be?
Right. So for relative valuation, using something like the price to earnings, PE ratio. Well, since they were unprofitable in 2024, a trailing PE doesn't really work. However, one analyst report from June 2025 cited a forward PE ratio of just 8.8 times expected earnings.
8.8? That sounds incredibly low compared to peers.
It really is. Exceptionally low. Robinhood's forward PE was around 47x, Schwab's around 28x. This huge disparity strongly suggests the market is applying a massive discount to Webull.
Likely due to those geopolitical risks we keep mentioning. Or maybe skepticism about keeping up that Q1 profit.
Exactly. It's probably a combination of both. The market seems very wary. So to try and look beyond that market sentiment, analysts use intrinsic valuation methods, typically a discounted cash flow, DCF model. The basic idea is simple. A company's true worth today is the present value of all the cash flows it's expected to generate in the future.
Right, you project future cash flows and then discount them back using a rate that reflects risk.
Precisely. The discount rate accounts for the time value of money and the riskiness of the investment. For Webull, given its volatility and those significant geopolitical risks, we'd need to use a relatively high discount rate. Based on an educational DCF model we ran, using assumptions like a high beta reflecting risk, recent growth rates informed by Q1, and standard market risk premiums, the estimated intrinsic value range for Webull, ticker BULL, came out between $14.50 and $18.75 per share.
Okay, $14.50 to $18.75.
Yeah. But it's absolutely crucial to stress this is an educational output, not investment advice. DCF models are highly sensitive to the assumptions you plug in, things like future growth rates, a discount rate, the perpetual growth rate. Small changes can lead to big differences in the final value.
Understood. Educational range, sensitive to assumptions. That gives us a solid financial picture. Now let's move into part 2. How is the market actually perceiving Webull right now? Let's dive into chapter 4. Market sentiment.
Right. Market perception for a company this new to the public markets is definitely still evolving. Analyst price targets and consensus ratings, for instance, are still pretty sparse. There isn't widespread coverage yet. Interestingly, after those strong Q1 2025 earnings were announced, the shares actually traded lower in after-hours trading. That suggests the report, even though it looked good on paper, didn't immediately convince the market or overcome existing concerns.
That's telling. What about the general news flow and media tone?
It's really polarized. You see positive news focusing on the strong Q1 financials, that 32% revenue growth, the swing to profitability. Also, the strategic partnerships like BlackRock and Visa and new products like Webull Premium and prediction markets get positive mentions. But then on the negative side, the narrative is dominated by that geopolitical scrutiny over its China ties. The House Select Committee letter, ongoing data security questions, that stuff gets a lot of attention. And you also have those persistent negative customer reviews bubbling up on places like the Better Business Bureau or Reddit complaints about customer service, fund transfers, account restrictions. This duality means sentiment can just swing wildly depending on the latest headline.
So a real mix of signals. What do specific market indicators tell us, like short interest?
Yeah, short interest as a percentage of float is a key one to watch for bearish sentiment. It tells you how many shares are being borrowed and sold short by investors betting the price will fall. For context, Robinhood usually has around 4% short interest, Schwab maybe 1%. We don't have the exact current figure for Webull right here, but given the geopolitical risks, a relatively high short interest wouldn't be surprising at all.
And high short interest could also set up a short squeeze, right?
Absolutely. If the price starts rising for some reason, those short sellers might be forced to buy back shares to cover their positions, which can push the price up even faster. It adds another layer of potential volatility. We also look at the price relative to the 50-day moving average. It's a gauge of short to medium-term momentum. Trading above the 50-day suggests bullish momentum, below suggests bearish. The price relative to the 200-day moving average is a longer-term trend indicator, but it's not really established yet for Webull. It only started trading publicly on April 11, 2025, so it needs more time, 200 trading days, for that average to be calculated meaningfully.
Okay, let's shift from market sentiment to who actually owns the stock. Let's look at Chapter 5, ownership structure. What do we know?
Well, the top institutional ownership patterns are still shaking out after the SPAC merger. It takes time for large funds to build positions. Investors should be watching whether well-regarded long-term institutional investors start showing up in filings, as opposed to maybe more speculative hedge funds.
What about insiders? Are they buying or selling?
Key insiders like the founder-CEO Ongquan Wang and the group president Anthony Denier are definitely significant shareholders, which you'd expect. In terms of recent transactions, there haven't been any open market buys or sells reported by insiders in the last 3 months. That's likely due to standard lockup periods that often follow a SPAC deal or IPO. There was one notable corporate action, though. On May 29, 2025, the company announced it would redeem its outstanding incentive warrants. The ticker was BULLZ because the main stock price, BULL, had sustained above $18 for a required period. That's a sign the stock had performed relatively well, at least for a stretch.
Now, you mentioned ownership structure earlier as a potential issue. Can you elaborate on the concentration?
Yes, this is a really critical point. Ownership concentration. Under NASDAQ listing rules, Webull qualifies as a controlled company.
What does that mean exactly?
It means that the existing shareholders from the original pre-SPAC Webull entity collectively hold over 50% of the voting power in the newly public company. This gives them substantial influence, arguably control over major strategic decisions, and the election of the board of directors. Essentially, they can potentially make decisions without the same level of input or checks and balances from minority shareholders that you'd find at most other U.S. public companies. It represents a significant governance risk for outside investors.
Right. Less protection for minority shareholders. That's definitely something to be aware of. This leads us directly into a crucial part of our analysis. Chapter 6. Risk assessment. What are the biggest dangers here?
We can frame this using a SWOT analysis. Strengths, weaknesses, opportunities, threats. We've talked about the strengths. Advanced tech, low-cost model, global capability, brand recognition. But the internal weaknesses are also clear. Those customer service issues, a product suite that's still a bit limited for long-term investors compared to the giants, a high dependence on trading volume for revenue, and that controlled company governance structure we just discussed. Opportunities are there too. Continued international growth, diversifying products further, getting better at monetizing their existing user base, and just riding the secular growth trend in retail investing.
Yeah.
But the threats are substantial.
Let's start with the big picture. What are the key macroeconomic threats? How exposed are they?
Webull's business model is highly sensitive to investor sentiment and market activity, so the macro environment is a huge factor. Think about key macroeconomic factors like inflation and interest rates. Higher for longer interest rates are kind of a double-edged sword for them. Well, on one hand, higher rates can boost their net interest income, the money they earn on customer cash balances. That's good. But on the other hand, when safe assets like T-bills are paying decent rates, it makes speculative stock trading less attractive, especially for newer investors. That could dampen trading volumes, hitting their PFOF and margin lending revenue hard.
And what about a recession, an economic downturn?
That would likely be quite negative. A downturn usually means lower consumer confidence, less disposable income for people to put into the market, and potentially reduced market volatility after an initial spike. All of those factors would directly hit Webull's key metric, daily average revenue trades, or DARTs. If DARTs fall, that powerful operating leverage we talked about works in reverse, and profits could decline sharply.
So volatility is kind of their friend, revenue-wise. Now let's tackle the elephant in the room, the geopolitical risks, specifically those ties to China. How serious is this?
This is, without a doubt, the most significant and unique threat facing Webull. It really does hang over the company like a sword of Damocles. Webull's origins, its founder's background, and its initial funding ties to China have placed it directly in the crosshairs of U.S. lawmakers who are increasingly focused on national security concerns related to China.
What are the specific concerns? Data.
Data security and espionage concerns are paramount. The U.S. House Select Committee on the CCP explicitly voiced worries about the potential for the Chinese government to access U.S. customer data, possibly citing Chinese national security laws that can compel companies to cooperate with intelligence agencies.
Even if Webull says data is stored in the U.S.
Even so, the concern is about potential access or legal compulsion, regardless of current storage location. This leads to the risk of potential for sanctions or bans. We've already seen actions like Tennessee banning the app on government devices. The nightmare scenario for Webull would be being placed on a U.S. entity list, facing broader sanctions, or even an outright ban from operating in the U.S. market. That would obviously be catastrophic.
And even short of a ban, the headlines must hurt.
Absolutely. There's the risk of erosion of customer trust. Continuous negative headlines about data security and China ties can severely damage the trust that is essential for any financial services firm. If customers get spooked, they can start moving their assets elsewhere, creating a slow bleed even without direct government action. These geopolitical factors are incredibly difficult to quantify in a financial model, but they have to be central to any investment thesis regarding Webull. It's a unique and potent risk.
Okay, this has been incredibly thorough. Let's try to bring it all together now in Chapter 7, conclusion. What's the final picture look like?
Yeah, we've definitely seen a company with a clear, compelling dichotomy. Let's synthesize by summarizing the bull case and the bear case. So the key bullish points. First, exceptional growth and operating leverage. Over 24 million registered accounts globally is impressive scale, and that Q1 2025 profitability was a critical potential inflection point, showing how their 32% revenue growth could translate into a dramatic swing to profit thanks to that operating leverage. Second, superior technology and product. Their proprietary platform seems to successfully balance advanced tools with user-friendliness, attracting that target demographic of active, sophisticated retail traders. Third, strategic expansion and innovation. Management has shown an ability to execute, expanding globally and innovating with things like the BlackRock partnership for robo-advisory, adding fixed income, entering new markets. And fourth, favorable industry tailwinds. They are well positioned to benefit from the long-term trend of finance democratization and growing retail investor participation worldwide. That's the bull case.
Okay, a strong growth and tech story. Now, the bear case.
The key bearish points are just as significant, maybe more so depending on your risk tolerance. First and foremost, that existential geopolitical risk. The China ties are a profound, almost unquantifiable threat. Intense U.S. lawmaker scrutiny, data security concerns, the potential for sanctions or even a ban, and the resulting erosion of customer trust, it's a massive overhang. Second, severe governance and operational risks. That controlled company status means weaker protection for minority shareholders. Plus, the high volume of customer complaints about service and fund transfers is a real operational risk that threatens their brand and could lead to significant customer churn if not addressed. Third, the hyper-competitive market and sensitive business model. They face intense competition from fintechs, incumbents, and pre-platforms, and their revenue model is highly dependent on trading volumes, making them very vulnerable to market downturns or recessions that reduce volatility and trading activity. And finally, their limited appeal for long-term wealth builders. Right now, the lack of core long-term investment products like a wide range of mutual funds or comprehensive bond offerings limits their appeal as a primary all-in-one brokerage for many types of investors.
And let's just quickly restate the valuation range from the educational model.
Right. Our educational discounted cash flow analysis yielded that estimated intrinsic value range of $14.50 to $18.75 per share. And again, just an estimate, highly sensitive to the underlying assumptions.
So putting it all together, Webull closed at $13.22 on July 2nd. What does this all mean for the stock? Is it the bull ready to run or caught in that bear trap?
Well, at $13.22, the current share price is trading slightly below the lower end of our educational intrinsic value range. This deep dive really highlights a company with impressive operational metrics and undeniable growth momentum. But it also faces equally undeniable and very unique risks, particularly on the geopolitical front. Ultimately, the core investment thesis here isn't just about the numbers on the spreadsheet. It's really a judgment call. Can Webull's powerful business execution and technological edge successfully outrun that looming geopolitical shadow and overcome its operational challenges? That's the crux of it.
So, after digging into all of this on Webull, what really stands out to you? Which of these powerful opposing forces, the impressive business versus the unique risks, do you think will ultimately win out for this company?
It's a fascinating question, isn't it? And it really forces any potential investor to confront how they personally weigh tangible business performance against intangible but potentially catastrophic risks. There's no easy answer.
Exactly. We really hope this deep dive has helped you feel much more well-informed about Webull Corporation and all its complexities. Thank you for sharing your sources with us and letting us guide you through them. If you found this deep dive valuable, please do like and subscribe to Stock Analytics AI on YouTube. It really helps us out. Remember, members at just $4.99 per month get priority deep dives on specific tickers you request. Plus, we're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those. And if you're just looking for a one-off deep dive on a stock you care about, you can always support us by dropping a super thanks right here on the video. Okay, just a quick but really important reminder. This deep dive was generated by an AI system. It's for educational and informational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Until next time, keep learning, keep exploring, and keep diving deep.